3 out of 4 founders who sell their companies regret it within 1 year. I know because I'm the guy that they call after the wire hits. And there are 6 major regrets I see all the time. 3 regrets you can see in advance, and 3 regrets you can't see coming until after it's too late. Just the other day, I received a call from an AI founder who called me because he was pending a $200 million exit, and he was looking and just basically scrambling to find commercial real estate to dump his capital into. He's moving fast, making decisions out of fear, not strategy. And so I slowed him down and convinced him to work with me on a 6 to 8 month process to be strategic about this reallocation and figure out where he actually stood. That conversation is what this video is about, because the mistakes he almost made are the same 6 mistakes I have watched founders make for 29 years. In this video, I'm going to show you how the 6 regrets that the founder almost made, 3 you can see coming if someone points them out, and 3 that will blindside you even after you think that you've prepared, how these work. And before we get to the first one, I need to show you a number that changes how you read every offer you will ever receive for your business. Let's say your business generates $2 million of EBITDA and sells at a 6 times multiple. So your headline number is $12 million. That sounds like a win. But after federal capital gains, state tax, and depreciation recapture on your assets, you may net $7 to $8 million in actual deployable cash, sometimes less depending on your structure and your state. Now ask yourself this question: how long does it take for $7 million sitting in a money market or even a diversified portfolio to generate what your business was already generating for you every single year? The math probably isn't even close. And the founders who regret their exits almost never ran it before they signed. You probably spent the money in your head already, am I right? You know the number that would change everything. This video is about what happens the day after you exit your business. And before we go further, let me tell you who this video is not for. If you're selling because of a serious health situation and you need to provide and protect your family, well, sell if you can. That is wisdom, not weakness. If you've ever built something you generally no longer believe in and the business is no longer an expression of your mission, sell. Get out clean. The video is not for you. But if you are selling because you're tired or scared, or someone made you an offer and the number sounded like enough, stay with me. Because what I'm about to show you is the part of this conversation that nobody has until it's too late. In my personal business in Texas, commercial real estate, I take the calls no one else gets. The call a founder makes 3 months after the wire hits, when they realize they're exposed to inflation and taxes and looking for a building to buy or a fund to invest in. I've taken those exact same calls for 29 years. Everyone wants to invest in commercial real estate after the fog of the sale and once they have their first post-sale conversation with their CPA, after they get back from the trip to Maui or the Bahamas or Hawaii. The Exit Planning Institute recently conducted a survey which reveals 3 out of every 4 business owners who sell their companies regret it within 1 year. They thought the money would bring joy. Instead, it brings a void. Most high net worth founders think selling their company is the ultimate reward. But after reviewing hundreds of major business deals, I have seen the exact opposite many times. Exiting your company completely is almost always a trap unless you plan to mitigate these 6 regret traps. So here are the 3 regrets you can see coming. Regret number 1, I call it the Monday test. So your period of rest after your sale lasts for about 2 weeks. If you do not have a specific hard task that requires your brain that Monday, well, think again. Before you sign the paper, take the Monday test. Ask yourself, what exactly will I do at 9 o'clock on the first Monday after the company is no longer mine? If your answer is, I'm going to rest, you're not ready. Based off all the calls I received, I can tell you you're walking straight into a 75% regret trap. Let me make the Monday test more specific for you. Here's a 3-question readiness audit, and I want you to answer honestly. Question number 1. Do you have a mission waiting on the other side that excites you more than the one you have now? Not equally, but excites you more. Question number 2. Do you have a replacement for the daily relationships your company gives you, your team, your clients, the people who need you to show up. Question number 3. Do you know specifically where the wire proceeds are going within 90 days of close? Not generally, but specifically, do you know? If you cannot answer yes to all 3, you're not ready to sell. Write those questions down. Rewind the tape. Write the questions down. Come back to them before you take another meeting with a buyer or any investment banker. The second regret is around challenges. I had a founder tell me that he sold because he was bored. He had built the company to about $30 million in revenue, and there was nothing left to prove. But 6 months later, he called me asking about buying a building. Any building, he said, just to have something to run again. You see, I found that builders build. That's not a personality trait, it's a neurological requirement of a sort. The brain that built a $30 million company does not idle. It either finds a new structure to build on it, or it starts dismantling the one around it. Your marriage, your finances, your health. Idle hands for a builder are not rest. They're a weapon pointed at your own life. Do not sell your business until you have a bigger mission waiting on the other side of the sale, one that enlivens you more. Not enlivens you equally, but enlivens you more. If you cannot name that mission in one sentence, you're not really ready to sell. You're just ready to stop. And those are 2 very different decisions. So you want to find a worthy challenge. In my book, 9 Steps to Build a Life of Meaning, chapter 1 is around the subject of pick a worthy enemy. Pick something that breaks your heart out in the world and go and address that. Go attack it with all the resources and all the energy that you can muster, because that's the high and holy act. So pick one worthy enemy. Pick one challenge that is worthy of your only life. Regret number 3, temporary problems that looked permanent. This is a very, very big trap. So why are you selling? Be honest with yourself before you answer that. Because most founders who come to me after the exit, and I do get those calls, they sold for one of 5 reasons that all turned out to be temporary. They lost a key person. The one operator who made the machine run, they didn't think that they could replace him without spending $750,000 per year or giving up more equity. So they just gave up because that one person left. The second thing I see is they had one slow quarter after 3 strong years and panicked about which direction the market or their business was heading and thought that they would only receive less and less the longer that they wait. The third instance is a spouse or family member pushed for more time with them. And instead of protecting the business and having that harder conversation, they sold the whole thing. It's the hardest conversations that we need to have next. We can't avoid the hard conversations. Instance number 4, a well-funded competitor raised a big $750 million round, and it shook their confidence in the future of their industry, and they became fear-based yet again. And instance number 5, they were just burned out from a failed product launch or a bad hire, and they just needed a way out that felt like winning instead of quitting. But sometimes the thing that you sell to yourself as winning is really quitting, is really giving up on yourself, not necessarily on a business. The business is the excuse for you giving up on yourself. So every single one of these is a temporary problem. And selling your life's work is a permanent solution to a temporary problem. That is an asymmetric mistake you cannot undo. If you felt any of those 5, you're not alone. I've taken that call more times than I can count. You've seen the 3 regrets now that you can predict. Now I want to talk with you through the 3 that you can't predict. But first, you need one more number. What is your walk-away number? Not your asking number, but your walk-away number. Most founders know the number that sounds good, but very few founders know the number below which the deal destroys more than it creates. Those are not the same numbers, and confusing them is how good founders end up in bad deals. So before you take a single meeting with a buyer or an investment bank, sit down and calculate 3 numbers. The first is your freedom number. The minimum net proceeds after taxes, after fees, after recapture or depreciation that would replace your business income for 20 years at conservative yield. The second number is your legacy number. That's the amount that allows you to fund the next generation of your family without liquidating principal. And finally, you've got the third number, which is your walkaway number. The floor below which no deal structure, no matter how clean, how great, how sexy, is worth signing. If you do not know all three of these numbers before you sit across the table from a buyer, you're negotiating blind. They know their numbers. You need to know yours. So I want you to drop in the comments right now, do you know what your walkaway number is? Not your asking price, your floor, your yes or no number. I read every comment, and if you don't know what it is yet, you will by the end of this video. Because section 2 is the post-exit regrets you can never see coming. These are the 3 regrets that you can't see. So you've cleared the 3 pre-sale regrets, you passed the Monday test, you know your walkaway number. Now here is the one that blindsides even the most prepared founders. What happens to your identity, your capital, and your judgment in the 18 months after the wire hits? Regret number 4 has to do with the sexy idea of starting a family office. Many founders say, I'm just going to sell my company and start a family office. They think this sounds high status. You have no idea how many calls I get every single week from someone that has a family office, only to discover after an element of due diligence that they really have nothing. They use the family office as a banner to raise capital for other endeavors. But a family office is just a brand new business that you do not know how to run yet. You have to hire people, look at complex deals, and manage overhead. You see what's happened? You traded one business you loved and a business that you understood for a financial business you don't understand and you don't know whether or not you will love. That's not the definition of freedom. It's just a swapping of problems with a learning tax applied. The family office trap is not about intelligence. It is about assuming that one game prepares you for a completely different one. And it almost never does. So I want to look at a sub-regret under this category of starting a new family office. And I like to call this the new war, which is a mindset pivot. So why do we assume that running a successful business automatically makes us good at investing money? Those are non sequiturs. They don't make sense. But you assume your competency transfers. This is the ultimate trap for high net worth alpha founders. When you run an operating company, you win by playing offense. You win through aggression and speed and deal making and taking market share and making fast choices. Your operating business is your shield. It's ongoing income that allows you to make operational mistakes, then absorb them and pivot on the fly. But the day after you sell, the shield is gone. You're stepping into a completely different battlefield, and the rules of engagement have completely not changed, but they've inverted. If you treat your new pile of cash like operating capital, you try to play offense with it. You will lose it to institutional players who play the money game for a living. When you run an investment house or a family office, you do not win by being aggressive. You win by saying no and playing brutal, unyielding defense. The skills do not cross over. The excitement does not transfer. Just because you made a fortune selling Cracker Jacks in the stands, you cannot assume that you have the data or the DNA to finance the stadium. Finance is the most difficult business there is because finance is the only business there is. Regret number 5, this is the what I like to call sell and sit, or the pina colada plan. When we go to Mexico, I always love to drink virgin pina coladas, or VPCs as I affectionately call them, by the pool. And very rarely will they charge you a lesser price without the alcohol. They'll always charge you $8 or $12 each. And that's sort of my fantasy about retirement. But I know that that's not really a good plan. Many of you are thinking about selling and sitting. So let's talk about what happens when you do nothing at all, or you plan on being on vacation or on cruises. The movies tell you that the ultimate happiness is this sell and sit model, retiring to a beach with a massive liquid net worth. But reality and even ancient wisdom dictate that human beings need useful, high leverage work to stay healthy. The architecture of your brain demands focus. When you completely remove the stress of building, your mind doesn't rest. It panics. It starts creating fake, artificial problems to worry about. The founders who sell their life's work and just sit still are almost always the exact ones who get sick, get divorced, create an alcohol problem, create a drug problem, or blow their wealth on terrible, impulsive investments out of sheer boredom. And while you're sitting there trying to rest, your cash is something like a melting ice cube. Real inflation is eating it every single second. Bad managers are waiting to steal it. Wealthy men get deeply anxious when they see a massive stagnant balance sitting on a digital screen. So they start making fast moves just to feel active again. They buy assets they don't understand just to feel the rush of the game. As someone who's executed about 300 commercial real estate transactions over the last 6 years with my team, I find it a little bit hard when a bored entrepreneur that's exited wants to insert themselves in the negotiations that they've only competed or done one time before. Yet I've done 300 iterations. That's a symptom of something deeper happening underneath. And without your operating business protecting you, you're standing completely exposed to the market's full-throated destructive winds. The ice is melting. In your old life, an operational mistake was a bad quarter. In this new war, losing your core assets on a bad investment mistake is unforgivable. Why would you ever trade something you understand and control for something you can never understand and can never control? The founders I talked to who avoided this regret all had one thing in common. They knew on day one exactly where the capital was going, not approximately, exactly. And this ties into regret number 6, which I call a fast pivot into a new enterprise or into a new business. A major mistake newly rich founders make is buying a completely different business right away. A tech founder buys a retail brand. A service provider buys a manufacturing plant. They think their leadership skill is a magic wand. Sorry to tell you, it is not. You succeeded because you spent 20 years learning one specific game. Do not start a new game where you are a child in the room of adults who have 10,000x the iterations. If you sell today and realize you hate retirement next year, how hard will it be to start over? In most fields, the cost of re-entry is massive. You lose your momentum, your core team scatters, and the market moves forward. Starting from zero at age 50 or 60 is twice as hard as staying in the game that you've already won. And when you enter a new game, a new business, by purchase or by startup, you discover about 3 years too late that not all competency is transferable, and iterations are often the only assets to hold. The cost of re-entry into a game you already won is almost always higher than the cost of staying in it. So let me offer you some better options. Don't get drunk on a big valuation number. Private equity firms will offer you a massive headline price, but the fine print will strip away your power. They use your current cash flow to pay off the debt they used to buy you. It's cash you would have had anyway. I assert that a smaller, safer check from a buyer who respects your legacy is almost always better than a giant, risky number full of tricks and conditions. When the money hits, there's a short high. Sure, it feels good. It feels sexy. You get to tell your friends at the club that you had a liquidity event. But then comes the flat line. A number on a screen does not wave hello when you walk into the room. It does not look to you for guidance. Human psychology dictates that we value our input far more than our output. The effort of the climb brought you joy, not the view from the top. They say the journey is what matters, which is a perspective you can only obtain as you approach the end of the journey. So here's something that no one really prepares you for. You will spend years probably preparing for the exit. Then you will spend almost no time preparing for the morning after. Most founders have a detailed plan for getting to the wire. Almost none of them have a written plan for what happens to the capital in the 90 days that followed the wire. That gap between the wire hitting and knowing exactly where it goes is where most post-exit wealth destruction begins. And those calls that I've been receiving for 29 years in commercial real estate, the pattern is almost always the same. A founder with 8 or 9 figures in liquid capital, sitting in a money market, watching inflation eat it slowly, making impulsive moves because the money feels like it needs to do something. And so the question you always need to answer before the sell is not just, what is my number? It is, what does the capital do on day 1, day 30, day 90, after the close? Institutional quality hard assets, income producing real estate, long-term leased industrial, assets that generate predictable monthly cash flow are not exciting. They're boring. But I would submit for your consideration that boring is the new sexy. They're not a story that you're going to tell at dinner at the club. But they do one thing your money cannot. They replace the operating income your business was generating. And they hedge the inflation your cash cannot survive by itself. And so the founders who navigate the post-exit period well are not the ones who got the best deal. They're the ones who had the deployment plan ready before they signed. That plan starts with knowing your 3 numbers, your freedom number, your legacy number, and your walk-away number, which we all covered earlier. If you need help building that plan, that's exactly the conversation that I have every day. The link to my LinkedIn for DMs is in the description. I'm available there anytime for a DM. So let me offer you 3 practical next steps. Number 1 is take the Monday test today. What would you do Monday morning at 9 a.m. after the exit? Number 2, before you talk to a buyer or an investment bank, talk to a commercial real estate operator or an alternative asset manager who takes the post-exit calls, someone who can show you where the capital goes after the wire. And number 3, don't sign anything until the terms are clearer than the price. Because if you're at the negotiating table right now, remember this rule: terms matter more than price. A $90 million deal with total freedom and no strings is vastly superior to a $120 million deal where your hands are tied for 5 years. Never let greed for a higher headline number make you sign away your personal liberty. To every founder listening, your business is your identity, your community, and your platform. Treat any exit not as a victory party, but as a major surgery. Keep your stake, protect your capital if you can. Never step off the field entirely until you've worked your way through the above regret avoidance techniques and have a plan to move forward to something higher. Perhaps the current game is where you belong. You see, the business world tells you to build, scale, and exit. But nobody tells you what happens on the first Monday after the wire hits. 3 out of every 4 founders learn the hard way. But you don't have to be one of them. Now that you know the 6 regrets, the next video covers the 4 deal structures that determine whether you ever get a chance to make them. Earnouts, rollover equity, the cash out trap, and the structure most founders never even consider. It's on screen right now. Watch it before you take your next buyer meeting.